John D. Rockefeller, the first billionaire in history, was once quoted saying that his only pleasure in life was to see his dividends come in. Clearly, people love their dividends, and for good reason. After all, some sources claim that over 20 years, dividends constitute 60% of the S&P 500's total return, a big number that we'll explain. But there are dangers to keep in mind, things that could quickly turn a great dividend stock into a dud. So before you go chasing dividends, let's go over the good, the bad, and the ugly on today's Plain Bagel. Capital appreciation gets all the love when it comes to investment success stories. Think of all the times you've heard of someone buying an investment for a few dollars, only to sell it for millions later down the road. But it's not the only component of your total return. After all, if you own dividend-paying stocks, part of your earnings will come from the income you receive. And there are many in the investment community who live for that extra cash flow. In fact, it's quite common to find investors dedicating their entire portfolio to dividend-paying stocks. And who can blame them? Dividends are like an allowance for grown-ups, with a lot of benefits. And unlike a stock's price, the return they offer is a bit more stable. But be warned, following a dividend investment strategy isn't as easy as chasing the highest yields. There's a lot to learn before you pick a dividend stock. And what may look like an amazing source of cash may actually be a ticking time bomb in disguise. So today, let's have a comprehensive look at dividends, including who pays them, why people love them so much, and what to watch out for when hunting them down. Theoretically, a company pays a dividend when it believes it cannot earn an appropriate return, reinvesting the money back into its operations. This is why larger, more mature firms, aka blue chip companies, tend to pay dividends, while younger, higher growth firms prefer to reinvest their earnings. But it's not just the age of the company that affects whether it will pay a dividend. The business or industry it operates within also plays a role. You see, some businesses are just better suited to pay dividends than others. Take regulated utilities, for example. These companies tend to have long-term customer contracts with governments to provide electricity to municipalities, which makes their cash flows fairly consistent and predictable. And projects to expand often take a while to pass the necessary regulation. Internet companies, on the other hand, operate in a rapidly expanding and continually changing environment with few barriers of growth. Because of these differences, utility firms are more likely to pay a higher dividend given their stable operations. So, the who of dividends is pretty straightforward. But as for why people love them so much, well, it may not be immediately apparent. After all, if companies can achieve capital appreciation by keeping their profits, does it really matter whether we receive our return via a dividend? Well, for some, receiving a dividend is just handy. For example, dividends are great for income investors, or people who need to withdraw from their holdings over time. After all, if you have a steady stream of cash coming into your account, you won't need to sell any of your investments to meet your withdrawal needs. This means you can avoid transaction fees, as well as the effect of market fluctuations on your income. Not to mention that in Canada and the US, most dividends are qualified or eligible, meaning they actually receive preferential tax treatment over interest payments from bonds, another popular income investment. Though it's worth noting that this benefit is for stocks from your own country. Another reason for dividend fandom has to do with their risk tolerance. People tend to value certain returns over uncertain returns. While a company may promise to make you money should they keep their profits, many investors would prefer to receive a payout instead. People also tend to believe that dividend-paying companies are more disciplined and conservative, making them more attractive to investors looking for a sense of security. But possibly the most important reason as to why investors love dividends is the snowball effect they provide. You see, a common strategy with dividend stocks is to take the income received and use it to buy more of the company. While the effects are slow at first, if you carry out the strategy for an extended period of time, well, your money starts making itself. Don't believe me? Well, let's go through an example. Imagine you have 20 stocks, each worth $20, and they individually pay an annual dividend of $1, so a yield of 5%. In year one, you get a total dividend of $20. And once you know it, at the current stock price, you can buy share number 21. Moving forward, this means that you'll receive $21 instead of $20. But if every year you put your money towards buying more shares, you'll end up with higher dividends, meaning you can actually increase the number of shares you're buying each time. And if you keep this going, at the end of 10 years, you'll have around 33 shares paying you a cumulative $33 a year. It's a perfect cycle. Buying more shares equals more dividends, which equals more shares, and you get the point. But it gets even better. With this example, we're earning 5% a year just by reinvesting our fixed dividends. But dividends aren't always fixed. If the company you've invested in is actually growing, you might see your dividend increase. After all, if a company is earning more money each year, shareholders should see a larger profit payment per share. So if we factor in a 5% dividend growth rate, by year 10, we're getting just under $60 a year, and the rate at which the amount is growing is accelerating. This is why people love dividends. Without any change in share price, your wealth essentially multiplies itself. Your dividends are buying more shares, those additional shares are earning you more dividends to expand the buying, all the while the amount you're being paid per share is increasing. If you let this carry out for a period of time, well, you can see it works very nicely in your favor. Not to mention that if share price goes up, you'll have more shares to benefit. And in case you weren't happy enough with those results, some shares offer something called a DRIP, or Dividend Reinvestment Plan, which allows you to automatically put your dividends into new shares free of charge, with some DRIPs even allowing you to buy shares at a discount to market price. So if you were worried about transaction fees or effort, you can now have all of this happening without any input on your part. That's a pretty powerful combination of mechanisms working in your favor. And if that's just with a yield of 5%, imagine what we can achieve if we buy a 10% yielding stock, right? Well, this is where we run into a bit of a dividend damper. You see, you're right in thinking that a higher yielding company will earn you a better return. After all, yield is equal to a stock's dividend divided by its price. So if we buy a 10% yielding stock, it means we'll earn 10% just from dividends. But unfortunately, high yielding companies can be very dangerous to investors. You see, there's a risk in looking solely at a stock's yield. Sure, while a high yield means a high return initially, it may also mean your stock's about to take a hit to its total return. Why? Well, remember there are two components to yield, and the fastest way for it to rise is not for dividends to increase, but rather for price to fall. A stock's price could fall when investors grow concerned about the company's operations. So a high yield company may simply be a firm that has run into some problems and as a result has taken a hit to its share price. So what, you may be asking? I still get a 10% yield, right? Well, that's the thing. If a company is struggling, it may be forced to cut its dividend to save money. So just as you bought the stock for that sweet payout, you're now facing a less attractive income. And there's a double whammy here. The markets do not like when companies cut their dividends. So not only will this hurt your dividend inflow, but you can bet that the stock's price will take another hit as well. Take General Electric, for example, whose stock dropped 12% when they announced they were cutting their dividend in November 2017. So while investing in dividend stocks can be a great wealth builder, chasing high yields can be a dangerous play. Instead, a better approach is to buy solid companies with a resilient dividend policy. Historic dividend information can be found online, so you can check out how consistent a company has been with their dividends and whether they're growing. And to check on the sustainability of the payment, you should look into a company's payout ratio. This shows how much of a company's profits are being paid out to investors. And if it's rising over time, it may show that a company is struggling to meet its dividend payments. For investors with income needs, dividend-only strategies can be useful, but there's more to it than just high yield rates. After all, if you're going to make your holdings pay you, you've got to ensure that they can afford it. And with that said, we're out of time. If you like this video, please hit the like button. And if you like what we're doing here, please subscribe. Hit the little bell icon to make sure you get notifications about future videos. If you have any feedback or topics you'd like us to cover in future videos, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.